Your credit score is one of the most important numbers in your life. It can mean the difference between paying or saving over thousands of dollars. It's unfortunately something I think isn't really well taught around the world, but luckily in this video, we're going to be taking a look at what you need to do in order to get your credit score into tip-top shape. I'm sure at some point you're going to want to start saving your money in order to buy your own place. Have that freedom and independence to go to your own home. Or maybe if you just want to rent an apartment for the rest of your life, maybe there's a car that you're really interested in that you want to go ahead and save up and purchase for yourself. Well, in order to purchase either one of these things, as well as anything else that requires you to go get a loan, you're going to want to make sure that your credit score is in great shape. Understanding what a credit score is and how you can get a perfect credit score is super, super important. If you guys are just able to give me about 10 minutes of your time, we're going to go ahead and break down what a credit score really is and take an in-depth approach on each of the individual factors that directly affect your credit score. This is completely free education for you guys. All I ask in return is if you enjoyed the video to please make sure to hit that like button if you gain value out of this video. It helps this channel out tremendously, and it allows for other people to also get free education on improving their credit score. Other than that, let's go ahead and get right into this video. So, what is a credit score? In simple terms, a credit score is just a number that determines how well a person is able to borrow money and then go ahead and pay that money back. The range for a credit score is anywhere from 300 being the worst all the way up to 850 range being the best. So if you see someone that has about a 300 credit score, I would not lend any money to them at all. You usually want to have a credit score of anywhere from like 650 to 700 and up. The way the credit scoring system works in the United States is pretty much when a bank or institution wants to go ahead and lend out money to people, they're going to go ahead and take a look at your credit score. When they go ahead and run your credit score, depending on what number they get back, they know that they're able and willing to trust you with the money that they're going to go ahead and lend out to people. Or on the other end of the spectrum, if they go ahead and run your credit and see that your credit score is actually pretty low, they'll actually go ahead and deny giving out a loan because your credit score was just too low. And there are many different things that directly affect your credit score. So now let's go ahead and take a look at what exactly makes up your credit score. In the US, we have 3 different credit bureaus. We have Equifax, Experian, as well as TransUnion. We also have 2 different types of scores, our FICO score, as well as our Vantage score. Now, I know this might sound a little overwhelming with all these new different terms, but we're mainly going to be taking a look at your FICO score, seeing as it is one of the most important and relevant scores used with other institutions. Your FICO score is the most used, with about 90% of lenders actually looking only at your FICO score. Now, it's also important to note that let's say your Experian score might be 670, whereas your FICO score might be 750. These different scores range since each one of these have their own different scoring models. But the most important thing to know is that all of these companies mainly focus on how well a person is able to pay back the money that is owed. So, how do you have a great credit score? Well, the best way to do this is to go ahead and break down what factors go into this. And again, we're going to be going ahead and taking a look at your FICO score. The first factor we're going to take a look at is your new credit. New credit is going to make up about 10% of your overall score. So if you've recently applied for any sort of new credit cards or any loans, they're going to go ahead and do what's called hard and soft pulls on your score. Now, usually this won't affect your score too much. Again, it's only really 10% of your overall score, but it is a factor that other institutions look at. For example, with Chase, they're pretty known for having a 5 for 24 rule. So pretty much if you've applied for if you've applied for more than 5 credit cards within the last 24 months, they're actually going to go ahead and deny you a new credit card from the Chase institution. And this is because lenders want to see and make sure that you're not taking on too many new credit cards in a fast amount of time. Because all of a sudden, if you have a very large increase in the amount of credit that you owe, this will be suspicious to the lenders that are lending you that credit, because this might be like a red flag that you're not able to pay off the amounts you owe for like your everyday stuff. So you need to go ahead and apply for new credit cards. The second factor to take a look at is going to be your credit mix. Your credit mix makes up about 10% of your overall score. Institutions just want to see that you have a nice varied mix of different credit that you owe. So pretty much it's going to be, as long as you have stuff like credit cards, auto loan payments, or mortgages, that's going to look really good in this credit mix category. As well as with the credit cards, they want to see that you're also borrowing from different institutions. So if you just have all your credit cards from Chase, it'll actually be better for you to go ahead and have a credit card from Chase, then maybe a credit card from Discover, and then perhaps a credit card from like Bank of America, where you're borrowing from different lenders and you're still able to pay the different amounts owed to these different institutions. Third category to take a look at is length of credit history, which makes up about 15% of your overall FICO score. When you go ahead and get a new credit card, not only does that affect the 10% new credit category, it also affects your 15% length of credit history category. Because let's say you have a credit card that you opened perhaps 5 years ago, and that's the only credit card you've opened since. And then today you want to go ahead and open up your second credit card. Pretty much the average of your credit history is going to be between that 5-year one and then that 0-year one, making about 2.5 years. That's why it's very, very important. Once you're able to go ahead and apply for a credit card, usually it's going to be when you're 18, I recommend go ahead and just get the first credit card that you're able to qualify for. That way you're able to build up your credit history as early as possible. So again, it's super, super, super important that you go ahead and apply for a credit card as soon as you're of age to qualify for one. That way you can go ahead and build up your credit history and go ahead and apply for more and more credit cards, especially in that time where you don't have to go and get, a mortgage or get any sort of loans. Perhaps you might have to get an auto loan soon, but with this credit history, it'll actually make it so if you want to go ahead and actually take out an auto loan, you'll actually be able to get better rates on the loan that you're applying for. But nonetheless, it should be easier when you're younger to go ahead and pay back those credit cards as long as you're responsible with those cards, because you don't have any liabilities holding you back. You don't have any sort of like life expenses you really have to worry about. So that's really the time you want to go ahead and just take out as many credit cards as you want, anywhere from 3 to 6 months, just get a new credit card for a couple of years. That way you can really build that foundation of your credit history. So like that, let's say 5, 10, 20 years down the road, because you open up all those accounts, your length of credit history stays substantially larger than if you were to just do 1 or 2. The fourth quarter that makes up about 30% of your credit FICO score is going to be the amounts owed. This is also known as your credit utilization. So this is going to pretty much take a look at how much money you owe to your lenders in comparison to how much debt you're allowed to take out. So for example, if you apply for a credit card that has about a $10,000 credit limit and you go ahead and spend $5,000 on that credit limit, that'd be about 50% of your total credit utilization. Of course, assuming that this is the only debt you owe for your credit cards. Whereas let's say if you had a $1,000 credit card and you only used about $100 of that card, then you only owe about 10% of your credit utilization. So because this is such a large factor in your overall score, it doesn't really matter how much credit limit you're able to access. What matters is the percentage of money that you actually use that you're allowed to take out. Let's say you have a $1,000 credit card versus a $10,000 credit card. What's more important isn't that if you have 1,000 or 10,000. It's the percentage that you use. You're going to want to only use about 30% of your overall credit line. But I would personally actually recommend about 10% or less of your credit line be used. That way, when lenders go ahead and take a look at the amount of money you owe on your cards, it's actually a very manageable amount. And they'll be like, wow, okay, because you only owe about 10% on your debt, you're clearly responsible and smart with the amount of debt you've taken out. So we're going to go ahead and offer you more. The fifth and final category is going to be your payment history, which makes up about 35% of your overall score. This pretty much takes a look at how long you have been able to responsibly pay back the debts that you owe. And because this is such a large portion of your overall FICO score, it's much more important to only have one credit card that you're able to responsibly pay back than go ahead and further take out more and more loans and have to pay those. Because if you show a repeated history of not being able to pay back your loans, this is going to negatively affect your credit score very, very drastically. So again, don't take out more debt than you need. Even with a credit card, if you don't need a credit card, I would still recommend you go ahead and apply for one just so you can go ahead and be able to build that credit history and just use that card to perhaps pay for gas or for your weekly coffee, things of that nature that are easily able to be paid back and you're not spending too much money in the long haul. Now, if you want to go ahead and join the 800 and up credit score club, here are just a few tips I've found to really help you get to that 850 credit score. Pay every bill on time. Remember, a lot of these different institutions, whether it's your FICO score, your Equifax, or your other ones, they're mainly going to be looking at how often you go ahead and pay back the debt that you owe to these different institutions. So it's important to make sure that when you go ahead and take out a loan or get a credit card, that you're able to pay back the debts owed to these different institutions. This shows that you're a trustworthy person to go ahead and lend money out to, and you'll be able to further develop your credit. Keep your card utilization low. So remember, this is one of the key factors that directly affect your FICO score. So lenders want to see that you're borrowing under 30% of the amount of credit that's allowed to use. This shows other institutions that you don't necessarily need to take out debt, but you just want to go ahead and use their different services. When you show that you're using a low amount of credit utilization, you're showing that you're able to responsibly pay for your things with your own money, and therefore you seem a lot more trustworthy to other institutions that want to lend money. Number 3, trust the process. This is going to take time. Paying back your bills on time and making sure to keep your credit utilization low over time is really what's going to drive your overall credit score. So just stay patiently using your card and paying it back on time and being responsible with the overall debt that you take out. If you're able to show that you've time and time again been able to consistently pay back your loans and you keep your card utilization low, that'll look a lot better than if you were to, let's say, take out a couple loans, not really pay them back until, I don't know, let's say a year later, and you're able to pay it in full. Even though you were technically able to pay back your loans, this is going to actually hurt your credit score because you're not showing that you're consistently able to pay back what you've taken out. So they might think that maybe you just got some sort of bonus from work or you're able to find some extra money, but you don't have necessarily that income or cash flow in your life to pay back the liabilities that you owe. Number 4, spend what you can afford. I think this tip is even more particular for credit cards because with credit cards, it's really easy to go ahead and just start paying everything on your credit card. And if you don't pay it back over time, you're going to start amassing a large amount of debt. So you want to go ahead and make sure that if you purchase something on your credit card, you're able to pay it back right away with no issues whatsoever. 5th and final tip is to apply to great credit card companies. You don't want to go ahead and apply to all these different credit card companies that you get into the mail. Hey, we have this credit card that you can apply for, but they have fees here and fees there when you go ahead and use the card. Because over time, you end up actually losing money because of all the hidden fees just for using some other institution's money. If you want to take out a loan, I'd recommend taking out loans from companies that you trust. They can be companies such as Chase or Discover or even Capital One. They have really great customer service and at the end of the day are there to service you. Remember, if you have a really great credit score, these companies will actually want to have your business and pretty much have you as one of their users. They're going to want to go ahead and lend money out to you at a better rate than the other competition. Therefore, it's going to be able to better save you more money. And with these different institutions, you usually be able to get different credit cards and different loans at the said rate, and they won't have any sort of hidden fees or additional costs added to the debt. Plus, something I know, at least with credit card institutions, what they'll do is if perhaps you've missed your first payment, but you have a history of paying back your cards on time, usually you can call them and talk to them and be like, look, I messed up. This is the first time I've missed a payment in, I don't know, a couple of years. Anyway, you can give me more time to pay back the amount, and usually they'll be able to say, all right, because you've done really good in the past and you have a really solid history of paying back your debt, go ahead and pay back your debt and we'll go ahead and pretty much forgive like that first missed payment. But remember, you're only able to leverage this amount of debt if you're able to responsibly pay back the amounts you owe to other institutions and banks. Well, I hope you guys were able to learn a lot about how to improve your credit score. I hope you guys enjoyed today's video. Please make sure to subscribe if you haven't already to get additional financial videos. And remember, today is a great day to have a great day. Thanks for watching.